Okay, so thank you everyone for coming. As Ann-Maree said, I'm Claire Watson. I'm a senior consultant in our specialised agribusiness division at FTI Consulting. So FTI Consulting is a global financial and professional services advisory firm. Within FTI, as I said, I work solely with agribusiness clients. We provide corporate finance and restructuring services across all agribusiness industries and sectors in Australia and globally. So what that looks like is that we work with not only businesses, but we work with financiers. So we often work with banks, we often work with external private equity firms, and we will do things like transaction advisory, strategic advice, pre-lending and independent business reviews, and then turnaround and advisory and due diligence reports. So today, there's 9 of us in our team. I'm based in Brisbane. There are 2 of us in Brisbane, and then we're based across Victoria and New South Wales as well. So today I'm going to be talking to you about strong business reporting. So we work, as I said, with clients at all stages of their financial journey. So that might be when they're starting out a new business proposal, a new business idea, whether that's to a bank, to private equity, or just perhaps succession planning, taking over businesses. And so there are many different components of business reporting, as I'm sure you know, but where we can break it down is that we can say that looking backwards and looking forwards are your sort of 2 distinct areas that you need to focus on to have strong business reporting and controls within your business. So today I'll be speaking to you briefly about some of the management tools that you can implement in your business and what the outputs would look like. So let's start with looking backwards. So management tools is a bit on this page, and I'll sort of elaborate on it as I go, but management tools, internal controls and record keeping. So we all know that everyone knows their business like the back of their hand, but often the reporting, the recording and the different aspects, processes within your business are in your head or maybe on a piece of paper. When we're looking at really strong, robust reporting in a financial sense, having that written down and having controls and having verifiable information just really creates rigor around your operations. And really what we would suggest is that if you don't have any sort of really regimented record keeping in your business at the moment, talk to groups like AgForce or talk to your industry bodies like MLA, GRDC. They will have examples of what they would suggest in terms of record keeping. You don't have to spend a lot of money, but it's really good to see what your industry says are the best management practice controls, and that can help you to provide some kind of basis for where you might go forward. And so why is this important? Is that it helps to inform your management accounts. And management accounts we work with all the time, and Aliesha will speak to this more, but management accounts differ to your, say, tax accounts, where you are looking at where your costs and your revenue within your operations are split. So costs, fixed and variable costs, and then your revenue. What we really see in strong financial reporting is where fixed and variable costs are broken down and where revenue is broken down. And so I'll just sort of talk more to the fixed and variable cost allocation. So overheads or fixed costs. Management accounting is really where you're trying to break down as much as you can your cost allocations based on where they're occurring. So we really want to be able to see, how much is it costing you to produce a ton of grain or a bale of cotton or like a head of cattle. It's really your overheads are the costs that don't change, whereas your variable costs are the ones that will change based on how much activity there is on your farm. So if you're producing more crops, you'll use more fuel, you'll use more fertilizer, whereas, you know, your permanent wages, your staff, your own costs to run your business, so your withdrawals, those are your overheads. So those aren't really changing year in, year out. It's your variable costs. And so for us, being able to see really strong delineation between, you know, what are the costs that you can't avoid or don't change versus your variable costs, what is increasing and decreasing, that really helps us to understand where your profit centers are within your business. And this will become sort of something that Aliesha speaks about, but something that we'll speak about now is when you're looking forward, having your really strong understanding of where your business sits, not only for yourself, but engaging with things like benchmarking and KPIs can really help to contextualize where your business sits within your industry. So benchmarking, you would have all heard about it. You might be engaged in it, but if you aren't, or you don't know where to start, reaching out again to your industry groups will be able to help you to maybe identify a group you could engage with within your region, within your industry. And benchmarking and KPIs, it's trying to put your performance, your historical performance, and understanding what are the different metrics that you can use to see where your business is going, and how can that inform what your forecasting is. So KPI examples might be operational metrics or financial metrics. And this is something that you'll do after the end of your financial year. It's an activity that enables you to look backwards on what your performance has been and take a really good look at it, like sort of taking stock of your financial performance. And where this becomes important is when we're performing forecasting and budgeting. To be able to do effective budgeting and forecasting, you really need to have a strong understanding of your historical performance. So your management accounts, as we've sort of been speaking about in the last 5 minutes, but your cost-based reporting, so allocating costs based on overheads and variable costs, and having KPIs involved within your business reporting helps you to sort of have that strong historical understanding of your business. And then it's important to increase the, you know, the assumptions and the financial drivers in your budgeting. So you are using your historical performance as the basis, and then you need to incorporate assumptions into what you think is going to affect your business going forward so that you can create your budget and forecast. And so these assumptions, or the key financial drivers of your business, are quite obvious ones usually. You know, you have your internal ones and your external ones. And why they're important to incorporate into your budgeting is that it creates a more robust picture of your business. And so for us and for your bank or for your lawyer or your external advisors, the more information that you have about how your business performs year in, year out, historically, and where you think that it's going to go in the future, enables you to have more informed and more rational and more robust discussions about your financial performance. And that will really empower you when you're perhaps going to the bank, asking for a new loan, an increased loan, a refinance. These are the kinds of controls that having them involved in your budgeting and forecasting will help you to improve the discussions that you're having. So I know that I've gone quite quickly, but we didn't want to speak for too long, and there's 3 of us. So business reporting, the historical and the forecasting, they really combine to help you to manage your risks. Overwhelmingly, we see that they help to improve performance, and they give you more of an ability to adapt. And it's really important to understand where your costs are, where your revenue is. And so when you're forecasting, if you know that it's going to be a wet year, incorporating that into your budget to see how will that actually affect your revenue. Are you going to grow more crops? Are you going to increase your stock rate? If it's going to be a dry year, conversely, how is that going to affect your business? And overwhelmingly, it's not just about making your decisions based on what you're doing now. It's informing your discussions so that when you maybe see a problem occurring in your business, cash flow issues in the next 6 months, it's going to be drier, or it's going to cost you a lot more for fuel and fertilizer than you'd expected 6 months ago when you did your first budget. Having that knowledge and having that ability to see where the different drivers are within your business allows you to have a more open discussion with your financial advisors, with the bank. And it arms you with that information that if you don't have the controls and the reporting in place, it doesn't necessarily detrimentally impact you, but it doesn't empower you either. And that, I think, is what we see as the most important part of all three of the discussions that we're going to have today, is that we ultimately want your business to thrive. We want it to grow. Our involvement in your business is to help to build long-term relationships. It doesn't matter at what point we've come into the business process with you, but we want to help to see your business grow. And I think it's important to also note, don't be afraid of asking questions. Be in the room when the meetings are happening. The daunting part are the first steps. They're the hardest, but overwhelmingly, they're the ones that pay off in the long run. I think that's about the sum of what I was going to say, Aliesha. I hope that I haven't spoken for too long.
No, you're right. Ann-Maree, are you wanting to open to questions after Claire's presentation, or how are you wanting to do that?
Yeah, sure. If anyone has any questions, please feel free to pop them in the chat and we can ask the presenters afterwards. There's no questions currently in the chat for you, Claire. So what I can do is open up the mics at the end of each of your presentations too, should people not be comfortable in typing in the chat.
Sure.
Is it still loading, Ann-Maree, or is it up?
Still loading?
Alrighty.
It's up now.
Alrighty. Thank you. Look, everyone, thank you for attending. I know these things are much harder online than they are in person, and it's a real shame that we're not in Roma tonight doing this face-to-face. I was keen to get my local Roma team at the evening to meet you all. I've got a great young energetic team of agribusiness bankers in Roma, so we'll see how we go, but thank you for making the time. Look, just as a way of introduction, I head up the agribusiness team for Suncorp in Queensland, and I'm based in Toowoomba. I've worked for Suncorp for nearly 20 years, so agri-banking's all I know, and I'll try to follow on from the good job that Claire's done this evening. I have to say that if every one of our clients used Claire's services, it would definitely make our job as bankers much easier. So thanks, Claire, for your presentation. Just wanting to just give you a bit of an update, I guess, or a conversation to be had about what we do at Suncorp and what agribusiness lenders do from day to day. So our group of lenders across the country, they look after a portfolio of agri customers. It's based on commercial debt over $1 million to be in a relationship managed model where we look after obviously all industries within ag, a couple there mentioned on the screen. And our job's to work with you as farmers and customers, and we enjoy that close relationship that we get to build with you over the years. We class it as a real privilege to be working alongside of our farmers and be involved in their day-to-day business decisions. As Claire said, you know, a part of our role is to work really closely with your other business advisors, whether that's the accountants, solicitors, agronomists. We all need to be working on the same page in your business to do the right thing by you. So as much as banks sometimes get a bad name, we do actually want to do the right thing by you as our clients, and the better that we can collaborate with your other advisors, obviously, the better job we can do for you and your business going forward. This evening, I just wanted to touch on the 3 C's of credit that you may have heard about, and that's what the bank will assess every time that we look at a credit application for you. And the 3 common C's of credit are character, collateral, and capacity to repay. And we look at each one of these C's to see whether the risk is worth it to the bank, whether you can satisfy those risk requirements to be approved for the application. So I'll just go through those quickly this evening. When we talk about character, we consider whether you're a new to bank or whether you're an existing customer. Obviously, we've got customers that we've banked for 20 years and we know everything there is to know about your business. So that's a lot easier one to tick off. But I guess if you're a new to bank customer, we actually do things like Googling your name because we want to know whether you've, you know, potentially got a criminal record or whether you're in the paper for all sorts of things. But we also, to assess your character, we look at your historical account conduct, and that might be requesting bank statements at your current financier. We want to look at, you know, is there dishonours everywhere all over your accounts, or how do you trade your account? And that gives us a good indication on your character or how you run your business. We also ask for ATO portals or confirmation that your super commitments are paid up to date, for example, and that obviously shows what type of customer you would be if those sort of commitments have been made in the past. We consider your length of time in the business, your experience. Are you new to farming? If you've grown up on the farm, you know the industry well, but if you're coming in and you obviously it's your brand new enterprise, we're going to be questioning that type of thing. Do you have the experience? Do you have the knowledge to run in this new industry that you're wanting to get into? And the other thing we look at is your credit report. So that obviously gives us very detailed information about your credit history and also helps us to add to that character piece with that. Obviously, it gives us information on your default history, that type of thing, but also the positive side of things, that you've got a good credit repayment history. So they're the things that we look at for the first C that give us a good indication of what sort of character the applicant is. And look, sometimes that's enough that we actually will not proceed with the deal. We see plenty of applications where that character test for us is just not met. And I think I said at the Dolby AgForce event, in my history of banking, there's very few client applications or client relationships that have gone wrong, but the very few that I've had, I probably can say that character test, there was always something in the back of my mind. They didn't meet that character quality. So we actually class this as a really important milestone to meet before we even look at the collateral and the capacity to repay Cs. So the next one we go to is the collateral, and this is also known as the security that the applicant or the client is wanting to provide as security to the bank. We look at your statement of assets and liabilities to determine your balance sheet and what type of security you've got to offer. So obviously the most common collateral that banks take as security is your landed security. For agri lending, that can either be resi or commercial or farming security, and all banks obviously have different parameters around their LVR, their ratio that they lend against that property. Predominantly Suncorp lend up to 70% against rural security and 80% against residential security. But there's obviously some specialised securities with feedlots and piggeries that there's some differences in there. But so that's what we call Cat A security. Category A is our landed security, which is our first point of call. And then there's our Cat B security, things like general security agreements, which is the old company charge, where banks will take a charge over the ABN, and that's to incorporate that the income that is earned by that entity. So if the time comes that we really needed to retrieve the money back to repay the debt, we do actually have a right to get the income earned by the entity to repay the debt by taking a GSA. In some cases, depending on the value that you're applying for, we may look at livestock mortgages or crop liens, which is another Cat A security. Rights of entry might be discussed by Fran later on, but rights of entry is where you might earn income on crops or running cattle on other people's property through agistment type or share farming agreements, and that right of entry allows the bank entry onto that property that's not owned by our client to retrieve the cattle or the crops, shall we need to claim that to repay the debt. So that's what a right of entry is. And the other form of collateral that we look to take sometimes are guarantees, and that might be, you know, when younger generation is starting out and they're wanting to use mum and dad's land or some equity to help them get into that business. We might take a guarantee from mum and dad, whether it's limited to their property or limited to a certain amount they're putting up as collateral. There's a bit of work around guarantees, and Fran might touch on that, but the bank needs to see that whoever's providing that security or providing that guarantee, there's a commercial benefit for them. And you might have heard a little bit around, you know, the Royal Banking Commission and the cases where guarantees were provided and the guarantors had no idea what they were going into. So banks have to be really careful now that there is a commercial benefit proven there for that guarantee to be taken in the first place. We require legal advice, you know, that type of thing to be given to make sure that the guarantors know exactly what they're doing before they sign guarantees. So that's the second C in collateral. So if we've proven that you've got a good character, we've proven whether there's a sufficient collateral for the lending amount required, then we go to the third C, which is capacity to repay. And this is sort of in the area where Claire was touching on, where information is key. As much information that you can provide to a bank makes this C so much easier to prove to your lending institution. So the capacity to repay C, we look at both your historical performance. That includes obviously your financial accounts, your profit and loss, your balance sheets prepared by your accountant, as well as your management accounts that Claire touched on for your most recent period. But we also want to look at your yield data. We want to look at, you know, if the last couple of years are rough due to drought, well, what is your year in, year out yields? Obviously, farming is not steady year in, year out, and we get that as a bank. But the more information that you can provide us as to the reasons why and what has been achieved in the past makes it much easier for your lender to tell a story to either their credit department or to them who has the DCA to sign off on it themselves. So information is key from a historical point of view, but we're also really keen to know what that future state looks like. You might be buying a new property and the future state's going to look totally different to what it did in the past. So that's where we look at your cash flow budget for the next 12, 24 months. There might be a stock breeding program where, you know, you're wanting to build that stock over, you know, 2-3 years. So it might require more than 2 years budget to show that where you're going to be in a certain number of years, that the bank can rely on those projections to repay the debt at a future date. Cash flow budgets are your actual projections, and then we look at a business plan, which is a 4-year, year in, year out sort of scenario. So that takes into account that you will have droughts, you will have floods, and we look at that year in, year out process that your next 12 months might be this state, but on a year in, year out, what's a normal we look at scenario for your business that we can count on to repay that debt. So your business plan, we have to use, you know, a 5-year average commodity pricing. Your cash flow budget might show the current cattle price, but we can't look at top cattle prices on a long-term scenario to repay that debt. So that's what we call a business plan, that year in, year out plan to look at, do you have the ability to repay that debt if interest rates, you know, move 2% and commodity prices reduce, so that there's some stress testing in that. So that's the third C. So we've covered off the character, we've covered off collateral, and we've covered off capacity to repay. Then we are just moving on to this slide about how we assess a transaction. And I guess this is just some points here as to how we come up with your credit quality risk score. So the question that we get asked a lot is what's my interest rate going to be? Now look, in agribusiness lending, it's very different to the home lending space, and we can't just say your loan interest rate is going to be 3%, because there's a credit risk quality assessment done in there. The clients that obviously have low equity, they've got great repayment history, they've been with us for 20 years, they're really strong clients, they should have a lot lower interest rate than a brand new business that's got no experience, leverage to the hilt. Obviously, there's a lot more risk in that type of transaction to the bank, so they're going to have a higher client margin on there. So the more that you can prove to the bank that your application is a good risk to take on, the better the interest rate will be. The credit risk is derived by these type of questions, whether it's your historical conduct, how many years you've been with us, your financial management practice, you know, how well do you look after your books, what type of data can you provide us. So these are the type of things that we look at to determine what that credit risk quality is to the bank, which obviously then helps us price up the transaction as well. Moving along, I just wanted to touch on what we class as the unspoken C. So you will see a lot of things around the 3 C's of banking, but probably the most important thing to us is the unspoken C, and that is communication. So Claire's touched on it. As much information as you can provide, the better off we're all going to be. But we acknowledge as banks that things go wrong, and you can have great cash flow budgets and the weather just doesn't flow through with that projection, and we get it, but we want to know about it as soon as it's happening. And the clients that we have really good relationships with, they're on the phone as soon as those you know, incidents that go wrong happen. If we're prepared with all the information as soon as it happens, we can be put in a position to help you. I always say, don't wait till your overdraft overdraws and that check's going to bounce before you get in touch with your lender, because the lenders can actually do something if they're aware of it, but trying to hide something that's gone wrong is not going to help anyone. So banks actually do want to help you, and I think the closer the relationship you can have with your agri lender, obviously the better you're going to be. As I've said there, your bank can't assist if we're not aware of what's going on. So that's a really important one. And I'll just see if I can move along here. Yeah, so we're just touching on that value in collaboration, like I touched on earlier. We want to work with your other advisors, with your accountants, with your solicitors, with your agronomists. So please put us in touch with those advisors. The relationships that we have great collaboration in are the ones that actually work so much better when we're all on the same page. But that's it from me, from a banking perspective. I hope that gives you just a bit more information as to why banks ask for so much information. We're not trying to be painful, but the more information we can gather, the better informed decision we can make on your behalf. So thank you.
Thanks, Aliesha.
Thanks, Aliesha. There's still no questions in the chat, so we'll go straight across to you, Fran.
Has that come up, Ann-Maree?
Sure has.
So you can see the
but
slides.
If you just go, I can see your whole screen. So if you just go, yeah, that's better. You've got
That's great. Okay. Well, thank you all for logging in this evening, and it's been really interesting to hear from Claire and Aliesha. A little bit of background about myself before I delve into my side of the presentation. I'm a special counsel and jointly head up the private clients team at Hamilton Locke. Hamilton Locke is a fairly new legal firm in Queensland, but we've been operating throughout Australia for a couple of years now. And I, along with some colleagues, Brett Heading, Trent Thorne and Nick Nolman, joined the team in February this year. We all have very long-standing relationships and ties to regional and rural Queensland. And I have actually presented this on this same topic at Mara over probably October last year. I unfortunately missed out on the Dolby presentation because I got COVID, but and I'm sorry that we're not here in person this week to meet with you all, but very glad that we could log on and present this as a webinar for you all. Now, we've just heard from two very business and finance-minded speakers, and you might be wondering why a lawyer would get involved on a financial literacy topic and presentation. But probably leaning on what Claire and Aliesha have both touched on tonight, is the reality that for primary producers and in supporting your primary production business, you really need a team of trusted advisors to really help you and guide you as part of your business operations. And we commonly, as lawyers, do get involved with business consultants like Claire and FTI, banking managers like Aliesha and Suncorp, and other advisors and particularly accountants. So often it is all of us and our heads in a room helping a client and primary producers through different types of transactions. One of the I've listed on this slide some of the main legal considerations that we actually find we get involved in often a big way, and that's commonly when you're actually engaging with your lender. So there might be a transaction about to be on foot, or there is one on foot, and you're needing some advice. So the common engagements that we assist clients with are the types of I guess what Aliesha has just talked through. So different types of loan applications, and be it also extensions and reviews of loan facilities. The other big ones that we see are sales or acquisitions of real properties or other types of primary production assets, such as livestock, plant and equipment funding. So, and I will focus on property acquisitions tonight, and that is normally a big one that we do get involved with. Leasing and other types of licensing type of arrangements. And then one of the probably forgotten ones is around general day-to-day banking requirements. So if you think about your business operations and how you operate that business, whether it's through a partnership, a trust, or perhaps a company. Sometimes there are requirements by the bank to update some of your governing documentation in relation to your business operations. And we often get involved to help amend or vary the terms of those governing documents. For any next gen producers, primary producers that have logged on this evening, my tip, and it does coincide with what Claire and Aliesha were saying about working with other advisors. And for primary production businesses, I think we've seen a really significant growth in not only land values, but also trading operations, whether you're a farmer or a you trade cattle or whatever it is. There's just a significant amount of wealth sitting there, and commonly in your own business and in the tangible assets that operate, that your business operates on, so the property and the land. My hot tip is to get in the room. So don't just be working the land. Get in the room and be in the room with your parents and with your advisors, and listen and engage with them and get an understanding of the business. It doesn't happen overnight, but the more you sit there and engage in the process and with those advisors, the more you will learn and also understand the nuances, fluctuations and the requirements of your primary production business. It may not be your business yet, but longer term, we do find that, the succession of primary production businesses to next generation. And if you've been in the room and listened and engaged, it can often mean that you're ahead of the pack, and it might actually just give you different business ideas as well. So we commonly get asked, what's the difference from a legal perspective in acquiring a property versus leasing different types of farming assets? It really comes down to leasing, licensing, or adjustment type arrangements are very different to actually acquiring an asset, and that's because there's often a term and rental or tenancy arrangements associated with the use of the land or those business assets. And I'll run through a little bit later in my presentation what really the differences are between a lease and an adjustment type arrangement, because there are differences legally. But if you're looking to acquire a farming asset, and in particular a property, that obviously means that you will own and have tenancy of that particular asset. I thought I'd mention the different types of processes we see in terms of acquiring a property. And the three main types are by way of private treaty. So you may not have heard of a private treaty, but it just means it's a listed sale and you can come in and make an offer. We are seeing at the moment a tendency more towards an expression of interest or an auction process, and I think that's to do with market conditions. So an expression of interest is kind of like a private auction where you put in an offer, you submit basically a written offer to acquire a property, and there can sometimes be negotiations on price, but often the agents and the vendor will liaise with the highest bidders as part of that EOI process. An auction, and probably we've seen most auctions over the last 18 months to 2 years. They've been very popular. Auctions are generally done in public, so it's a public auction. And I think the reason we've seen many auctions as opposed to EOIs or private treaty sales is because of the significant increase in land values over the last 2 years. So it's created quite a competitive market in terms of going down that public auction process. This slide really sets out the legal process as we see it in terms of if you were to go out and try to buy a rural property. Aliesha, I am going to make mention of the finance application process because it has really changed in our view from what we're seeing on the legal side over the past 2 to 3 years off the back of the Banking Royal Commission.
Yep.
We used to see finance applications taking agribusiness banking managers getting finance approval through for customers and clients within usually a 14 to 30-day process. My view, and Aliesha, you might be able to comment on what it's sitting at the moment, but I haven't had any clients get them through really under 30 days, and it's more likely 60 to 90 days. And that time frame is really off the back of not a piecemeal dripping of information to your banking manager. It's, you know, the application's made on the date that you get all of the required information to your banking manager. Aliesha, can you comment on that a little bit?
Yeah, sure. Look, Fran, if we were given all the information at the time we were given the signed contract, I would say the best we can turn a finance approval around is probably three weeks, 21 days. But that assumes we've already probably had conversations with the client that they're looking for a property. We've already got all their financials entered into our system, and we're ready to go. Like, we've got a fairly good idea of what they're looking for. If no conversations have been held at all, it does take a lot longer.
Yeah.
And probably one of the main issues is valuers. There's, you know, we're waiting a really long time for valuation reports. So you are right with that.
Yeah. Because we're finding with some clients, it's you get your finance approval, but it's conditional still upon getting the valuation after being successful, say at an auction or via an EOI process. And I guess another tip around, if you are considering acquiring a property as part of your business growth or you're entering into the market, is and again, we're recommending this to clients, is to go out now and get organised, get a finance application in, and get some pre-approval up to whatever limit you can, which can also aid you in looking at different types of properties, different locations and different sizes. It's for an EOI or auction process at the moment, definitely for an auction, you'd need to have finance approval or funding available, because auction contracts do not generally contain any finance conditions. EOIs, we're finding, Aliesha, I don't know if you're seeing this as well, we're finding EOIs, while you probably used to be able to put in, you know, 14 days finance condition, everyone else has their finance approved. So if you have conditions in the EOI process that you want to put in, such as finance, they're often not accepted.
Yeah, definitely, because you're always going to choose the buyer that's got pre-approved finance, aren't you? It's going to
yeah, exactly. And so on that, Aliesha, one final question. So if you get your pre-approval finance, you can get it for a specific, if you have a property in mind, you can generally get it for a specific property. And if you, let's say that was going to auction and you weren't successful, you can often get it changed to a different property that you might find, subject to obviously perhaps some different conditions.
Yeah, that's right. So if a bank's approved, say, a $5 million property purchase for property A and they've missed out, you know, it's a lot easier scenario to keep that $5 million approval in place for property B, subject to, does it run the same number of stock? Is the cropping, you know, country the same, that type of thing? But it's definitely, 80% of the way. Yeah,
excellent. So the finance application and having that approval is commonly what we find, that's a process in itself. But also the process of going through an acquisition of a property is quite a big process. And I've actually had clients comment to me where they might have been going to an auction or going through an EOI process and gotten the contract review. You've talked about structure, you've got your finance approval in place, and they haven't been successful, but they've actually found it to be a really useful process to go through in terms of their own learning and education around what it takes to actually make an acquisition of a real property these days. So I'll talk through this structure and basically steps plan So one of the first things that we, as I always talk to clients about, and often are guided by one of a client's trusted advisor, like an accountant, is around structure. So there are different types of structures in which you can acquire a property. We commonly see sole traders, different types of partnerships, which might be a partnership of individuals or partnerships of trusts, a trust on its own, or a company. Now, the reason that's important is because there's disadvantages, but also advantages of different types of entities, and you've got to understand how it might affect, you from a tax perspective, from a risk and asset protection perspective, and also I'll touch on the transfer duty exemption in Queensland. There's a primary production exemption sometimes that actually impacts on the way in which we advise clients to acquire a property, particularly if it's part of a succession plan and it's being passed on to the next generation. So you've got your structure. Let's assume you've made your finance application. Then regardless of whether it's a private treaty, an EOI or an option, you enter into the contract. If it's a private treaty arrangement, you might have an ability to conduct or include a due diligence condition. Again, we're finding a lot of vendors just don't want any conditions associated with or put into the contract. So there can be an ability for us to actually help you conduct due diligence on the land itself prior to acquiring. So doing different types of property searches that might tell you what are there water licenses, what are the rights attaching to those, what's the veg management, what's the mapping showing. We can advise around all of that. The next step is assuming you've got your finance approval. We then work very closely with your bank to actually get everything finalised for completion. So that would include land title transfer forms, transfers of any water licenses or allocations as it may be. If there's business assets being transferred, dealing with the transfer of those assets. GST requirements, so depending on what the GST clause is saying. So we go through all of that and give effect to completion of the purchase of that property. Now, while Aliesha is definitely best placed to help you with what you need for finance applications, I just thought I'd mention we don't always help clients through that finance application process, but at times we do to help deliver documents and information that a bank is requiring. And these are some of the common ones that in the past that I've seen clients be asked by their bank to provide. So things like, and I think if we read through this list, it really leads into the 3 C's that Aliesha was talking about. So they do go hand in hand. So what are your current assets and liabilities? Really, what's your balance sheet? What's it showing? Your budgeting and forecast for a business for the business, and your ability to demonstrate repayments of interest and principal. And that's where Claire gets involved. If there are loan approval requirements, including provision of guarantees, which we do find if you are acquiring an asset not personally, so if you acquire as a sole in your own name or a partnership of individuals, there may not be as heavy guarantee requirements. But if you're acquiring through a trust, a partnership of trust, or a company, the bank will commonly want to see security from you as controllers of those entities personally. So the other types of things, so we talked about in the previous slide, you get your loan approval and then everyone works towards completion. So once the completion date is generally set in the contract itself, and so between the finance approval date and actually completion, you as the customer have a very busy time signing the bank's financing documents, so loan agreements, security, and the general security agreements that Aliesha talked about earlier, so charges over other assets. And in terms of guarantees, the banks require you often to get, or it is a requirement, you've got to get independent advice on providing the guarantee in support of the finance and the facilities with your bank. So one of the hidden costs that is sometimes not appreciated at the time of considering acquiring a property are things like stamp duty, or transfer duty as it's now called in Queensland, land titles registration fees. And I think you've always got to factor in that there will be legal costs and commonly accounting costs for lawyers and your accountants actually helping you through the process of acquiring the property. So transfer duty, that's a state-based tax where if you're just going through a private treaty, EOI or auction process, you will have to pay transfer duty in addition to the purchase price under the contract. And the transfer duty amount is generally, give or take, it's between 5 to 6% of the market value of that property that you're acquiring. So it can be a really significant cost. We find, Aliesha, I'm going to throw to you again, we find some banks will lend you the transfer duty amount and others won't. And it can depend, again, on your LVRs. Probably, Aliesha, in my experience, Suncorp don't lend the stamp duty amount as commonly as what I've seen some other banks. Is that?
Yeah, look, depending on the equity position, most of our clients would seek those costs to be covered. And to be honest, in my experience, we do cover it, but there's the available security there, I guess. It's a tough one for obviously large amounts, as a lot of them are, to come up with that cash. So we would factor that normally in.
Factor that in, yeah. So I think it's just important when you're doing your finance application to just consider what that transfer duty cost will be. Again, if you're working with your team of trusted advisors like your accountants, your lawyers, your business consultants and your bankers, we would always remind you of that. But you need to consider that will be an additional cost. And transfer duty is an interesting one. It's an upfront payment. So if your bank is providing that transfer duty amount, it has to be provided at completion, because you cannot lodge any transfer forms that actually give you title to a property without the transfer duty being paid first. The other one, and Aliesha, we see it in the loan agreements, it's because if you've got a financier, the bank will commonly cover the land titles registration fees. And this is about 1% of the purchase price, and I commonly see it just built into your loan agreement cost, because if you have a financier, they will actually attend and lodge the transfer forms more commonly via a PEXA arrangement these days, but they will wear that cost and on-charge that to you.
Yeah, that's part of the bank's fees and charges, split up into what the government charges are and what the bank fees are, but we will debit the loan on the day of settlement for that amount.
Yes. So the other types of fees is just if you've got a water license or water allocation, there may be additional fees for lodging those, registrations and releases of mortgages, and registration and relinquishments of leases. So those types of costs are commonly sorted out and apportioned between the vendor and the buyer as part of the settlement requirements and in a settlement statement, but you'll commonly see them set out and accounted for. So I'll quickly touch on leases and licensing, leases and adjustment type arrangements. Before I do, I guess the reason I wanted to talk about lease and licensing arrangements, besides the fact that there are financial obligations and requirements involved in entering into these types of arrangements. The other side of it is, from my experience, actually entering into a written agreement and getting advice on entering into that agreement at the outset, if you are going to lease land or adjust land, can be really important, because we are finding these days very much so that handshakes don't cut the mustard at all. That's because there can be, you know, a bit of a he said, she said type arrangement. There's uncertainty as to what the terms were because they're not actually written down. And if you are having to enforce or seek retribution for an arrangement for the use of a property that's gone wrong, it can be very hard to prove. So I often liken it to actually getting some advice or getting a lawyer to actually prepare a lease or an adjustment agreement as likened to a form of insurance for your business. You get it prepared, you have it reviewed, you enter into it, you put it in the bottom drawer, and hopefully you never look at it. But if you do, you know that it's set out and it should provide pathways and processes for if something has gone wrong, whether you're the landlord or the tenant, the adjuster or the adjustee, whatever the arrangement is, you'll have certain rights. You'll also have certain obligations on you, and it can make it a little bit more clean cut to deal with any issues that arise as part of that arrangement. So a lease is a form of use of land agreement that's actually registered on title, and if it's for a period of over 3 years, there's actually a requirement that it has to be registered on title at the Land Titles Office. The reason being that by actually registering a lease that's over a 3-year term, it gives a tenant indefeasibility of title of that actual arrangement. We commonly find that leases are more common for whole of property type arrangements as opposed to adjustments, which might be more focused on uses of different parcels or lots or different paddocks even. So they're more long-term arrangements where someone comes in and they're using the whole of property. Where financiers get involved in leasing arrangements is we find, so if you're acting for the tenant is often required to provide either a security deposit or what's deemed to be a bank guarantee. A bank guarantee, so a security deposit would be a sum of money that is made available to the landlord, and it sits there in case the tenant defaults on the rental payments under the lease or other types of important terms under the lease that might allow the landlord to actually call upon that money. Commonly, though, we find clients are not really wanting to have money just sitting there, and instead they would often do prefer a bank guarantee. A bank guarantee, Aliesha, you can correct me if I'm wrong, but you make an application to your bank to have the bank guarantee provided by your bank. It's very similar to having the security deposit there, and again, if you're the tenant, if you've defaulted under rental payments or under some really important terms under the lease, the landlord has an ability to call upon that bank guarantee, and your bank must immediately pay the funds that have been called upon, obviously up to the maximum amount of the bank guarantee to the landlord. The other thing to consider with leases, if you are a landlord and you have finance over your property is used as security as part of any financing arrangements, or alternatively, if you're a tenant and perhaps your bank has some financing security arrangements over livestock that are being run on a leased property, often the bank will want rights of entry onto that property. They can be competing, but they are very common, and often you're obligated to actually negotiate that as part of the lease arrangements to ensure your financier does have an ability to enter onto the property, again, if something's gone wrong as part of the leasing or, livestock arrangements. I'm going to skip to adjustment arrangements and come back to those different terms, but adjustment arrangements are really more informal. It's a more informal type of arrangement where again, there may not be an adjustment of a whole property. We might see certain paddocks or part lots actually being adjusted, the land being adjusted. There are different arrangements for adjustment, and it really depends on what you negotiate, and whether you're the owner of the land and you're being engaged to actually care for the stock, and that is a common adjustment arrangement. But at times it might just be a licensing type adjustment arrangement where an adjustee can come onto, they put their cattle on the land and they're able to come and go themselves, and they actually have obligations to maintain paddocks, maintain fences, look after the water and look after their own stock. While probably under this arrangement we don't see as many financier type involvement, you do also just always need to be mindful, particularly if you're the adjustor, so if you own the land, that if you have, again, financing and the land is used as security, that you check with your financier whether they have any requirements to be held over the adjustee arrangement. So similar to the lease, so whether it's a lease arrangement or an adjustment arrangement, there are different types of terms that we see included in these written agreements, and that's to do with the adjustment fee or the rental amount. What are the obligations of the landlord versus the tenant, and the landowner versus the stock owner? What's the term of the arrangement? What under the written agreement would actually cause the arrangement to be terminated, and what are the default requirements? Again, access rights, so rights of entry for all parties and also for financiers. The insurance requirements, which can be really important, and depending on whether you're the landlord or the tenant or the adjuster or the adjustee, there can be different and competing requirements for insurance. So they're the types of different terms that we commonly include in these types of written agreements, and it's really important that they're actually covered off. So that's it from me this evening. Happy to take questions, and I know Aliesha and Claire would be the same. If you have any questions around what we've discussed tonight.
Thanks, Fran. I'll just change the settings on the meeting options to allow people to ask questions should they wish.
I can see a question there for me. Do you take into account the FMG risk when assessing applications, or is it not a concern? Oh, look, it's very much on the bank's radar, Jeff, at the moment, but we're not declining deals because of it. You know, we need to consider it, but we're not changing the way we assess applications at the moment. If that answers your question. It's probably more banks we're concerned about. If there was an outbreak, you know, how are we going to help our customers through it? But it's not changing our appetite for the beef industry by any means at the moment.
Good to hear.
Does anyone else have any further questions? You're quite welcome to unmute yourself if you don't want to type it in the chat. Might be all. Okay, well, I just want to say thank you very much, ladies. Thank you, Fran, Aliesha and Claire, for your time in presenting tonight. And thank you everyone very much for taking the time out tonight to watch this webinar. It is being recorded, so I can send you a copy after tonight. And I can also send you the details for each of the ladies should you wish to get in contact and if you have any further questions tomorrow. I will put my details up on the screen in a second, so if you have any questions, that's where you can follow up with my details. All right, thank you very much, everyone.
Thanks.
Thank you.
Thank you.
Thank you.